Coming up on the SBS On the Money podcast, the Australian share market at a 3-month low. The Reserve Bank meets and the dangers of using AI for financial advice. All of that and more next. Hello, everyone. Welcome to the SBS On the Money podcast for this Monday, the 16th of March, 2026. It's a day where the Australian share market fell. We'll have more in a second, while later in the podcast, the dangers of using AI for personal financial advice with ASIC Commissioner Kirkland. First to the ASX 200, which tumbled in the morning and never really recovered at the end of the day. The index closing 0.4% lower to a fresh 3-month low. Gold miners lost ground as the precious metal dipped below $5,000 per ounce. The miners also fell, BHP down 1.2%. Energy stocks, though, like Woodside, did well as the oil price rose slightly. Brent at around $105 at the market close. The banks were mixed ahead of the RBA's decision on interest rates tomorrow. For more on that and the rest of the day's market action, I spoke with Mathan Somasundaram from Deep Data Analytics. Mathan, can we start first with interest rates? The RBA is meeting today, a decision expected tomorrow. Can you run through what the market is thinking will happen? And do you think the war in the Middle East has something to do with a potential interest rate rise, or was a rise always on the cards anyway?
Yeah, I think I think you're right in multiple angles there. One, I think the hike was already in play. On the interbank lending rates, the market's expecting pretty much one hike in the next 3 months and another one in the next 3 to 6 months. So there's 2 hikes in play already. I think the war with Iran has obviously created substantial inflation that's going to come through, and that more or less will force RBA's hand. Now, the argument that they'll have against it is the fact that the Aussie dollar is quite strong compared to what it was. So a hike would make it worse. But the other side of that argument is the fact that I don't think any central bank is going to be thinking about cuts anytime soon. I mean, this is a week where every central bank is meeting, almost everyone, from Japan to US to UK to even the smaller ones like Brazil and so forth. There's a lot of central banks meeting, and I don't think anyone's got rate cuts in their outlook for the next 3 to 6 months.
What does it mean for the States? The US Fed, as you implied, will also meet this week. There's been the market has been expecting rate cuts from the US this year. What's the likely outcome, and have rate cuts perhaps just been pushed back later in the year?
Yeah, I mean, at the moment, the implied probability is that it's 50-50 for a rate cut in September, October. So that's been pushed back. The market was expecting 2 cuts. The Fed was flagging 1. And I still think there's the best case scenario is 1 cut. But the reality is, if the inflation comes through, and we already know that tariffs were removed by the Supreme Court, the US government returns served with 15% on everything. And you're going to get some corporates who are probably not going to want to raise prices to get the wrath from the White House. But now you've got 50% rise in oil price. So inevitably prices are going to go up. So they've got to cover to raise prices. So in that outlook, I suspect prices are going to keep rising. Inflation is probably going to get to 4 to 5%. And so the Fed will keep delaying it, and we might not even get a cut this year.
From an investment's point of view, right? What are your clients telling you? How worried are they? And then what do you tell them? I mean, are you worried? And does this situation in the Middle East really have the potential to really shake up investment markets? Because when we look at equities anyway, it could be worse, couldn't it?
It's always a tricky question, that one. You have to put it in context. The biggest problem is obviously you're looking at the US economy because it's 50% of the global economy. Now, you started to see financial stress last couple of weeks coming through private credit, and the banks, redemptions, all of that is playing out. You've had US GDP growth rate go from 4.4% now down to 0.7%. So almost everyone will assume that inflation is going to rise more than 1 or 2%. So in reality, US could be looking at stagflation. So in that scenario, yes, financial stress is going to get worse, economic slowdowns are going to get further, and that will bite. And now the economy, then you look at what's the flow-on effect for markets. Well, the markets were pricing in somewhere around 12 to 15% growth rate in profits for the next 12 months. That's going to be tough when the economy is not growing. So I think the longer the war goes, the worse the situation gets, the more fuel that's going to flow into inflation, the less rate cuts, it's going to be tough for the market. So we're at multi-decade high multiples. They're going to be challenged. I think the private credit problems in the US are just the canary in the coal mine. You're going to get financial stress. We've seen loan frauds in the banking system domestically. These are things that happen when we've got asset bubbles being funded by debt. You get into that late cycle play and the debt problems come through. And I suspect that's going to be a huge issue. Our 10-year bond yield in Australia has reached nearly 5%. That's 15-year high. These things will test leveraged economies, and we are a leveraged economy. So I think it's going to be a tough play for the economy over the next 3 to 6 months, depending on what happens, and that'll have an effect on the market.
So as a result, what are you telling your clients? And with what you're expecting, how are you playing it then? Where are the opportunities? Where do you sit?
Yeah, I mean, we've been talking about being exposed to inflation cycles, right? And so we've been long gold, we've been long energy, we've been long food. We still think those things will hold up quite well. Now, the problem with bond yields is when bond yields are going higher, it doesn't matter where you are, everything gets hit. The higher cost of borrowing hits every asset class. So in the short to medium term, volatility is going to be high, everything is under stress. So it's really hard to predict. You have to think medium to long term. I think we're still in a double inflation cycle like the 70s. Interestingly, that was driven by energy prices as well. And we're probably going to do the same. Now, how long does it go in the Middle East? God knows. But one thing we know is the supply side destruction that's happening now is not going to be fixed in a month or two. So even the most optimistic case, we're probably going to have supply side issues for at least 3-4 months. Worst case scenario, that could be 6 to 12 months. So there's a fair amount of energy and fertilizer and chemical disruption. So that is going to have an effect on the global economy and will have an effect on the market. So you want to be long inflation cycles, you want to be long defensive yields, and you want to have a pretty good risk management because it's going to get a bit wobbly.
That's Mathan Somasundaram there from Deep Data Analytics. Right, the financial watchdog now is urging young Australians to act with caution with a new survey showing nearly 2/3 of Gen Z, that's those 18 to 23, are turning to social media and so-called finfluencers for financial advice. 1 in 5 rely on artificial intelligence. And in fact, 64% of the 1,200 young people surveyed by the Australian Securities and Investments Commission said they trust AI tools. ASIC Commissioner Alan Kirkland says financial advice accessed on social media and using AI is risky as the information can be incomplete, promotional or misleading. And he spoke with Stephanie Youssef.
So, Alan, nearly 2/3 of Gen Z are turning to social media for financial advice. How concerning is that, and what are the risks involved?
Well, it's a concern if people are over-relying on social media. I mean, it's not surprising that lots of people are going to social media for financial information because it's part of everyday life for so many people. But I guess our concern would be if people are placing too much reliance on what they see on social media because the quality of information that you get varies quite significantly. And so our advice is that if you're going to go there, you need to balance it out with information from other sources, as wide a range of sources as possible, including trusted and reliable sources such as government information.
More than half said that they trust advice they see on social media or from so-called finfluencers. Should they be more skeptical?
Look, I think it's helpful to have a healthy degree of skepticism in relation to anybody that's telling you where to invest your money. But that's particularly the case on social media, and especially when it comes to influencers. I mean, influencers, people who are influencers giving financial information to people on social media, are often doing so because they get paid for what they recommend. So you've got to understand, often they've got an agenda that is not aligned with your own interests. So you've got to be particularly skeptical with anything that's being pushed as an investment option by somebody playing that influencer role online.
Out of everything that you've seen in this study, what's of the most concern?
I think the thing that surprised us, I guess, was the rise in trust in AI tools. It's still not, AI tools are still not the most popular source of information for financial decisions, but they are highly trusted by younger people. And that was an interesting finding for us because they're still relatively new, and because we know that the quality of advice that comes from AI tools can vary quite a lot. It really depends on how well you know how to ask the question, but also what's the quality of the data and information the AI tool is drawing upon. And as an individual user, it's really hard to judge whether those two factors are right and whether, as a result, the information that you're getting is really going to be good for you.
And how concerning is that growing trust in AI, considering that it can often get things wrong?
Well, it's only concerning, or most concerning, I guess, if people are over-relying on AI. From the work that we've done looking at what AI does in relation to financial tips and advice, where it can really be weak is in giving you advice that's particular to your circumstances. So often it'll give advice that may be okay at a very general level, but it may not be what's right or best for you. And it's also not very good at giving a balanced sense of the risks of what it might be suggesting. So it'll often sort of promote a particular option and give it what doesn't look like a hard sell, but really is, without actually sort of reflecting on the risks involved in that and what some of the other alternatives might be.
Most of the young people surveyed said that they've seen social media ads encouraging crypto investment. Does that raise concerns about how these products are being marketed online?
We were surprised at the high proportion of people that had seen social media ads pushing crypto, and that is a real concern because crypto is not like other types of investment. It actually moves rapidly. The value of it moves rapidly. So you see, particularly through social media, influencers hyping up, building up the hype around a particular cryptocurrency or crypto investment. The value goes up really rapidly, and some people will make money out of that. But what then happens is the value will crash and a lot of people will lose money. So there is a real particular set of, I guess, dynamics that happen around crypto and social media that can really result in people losing a lot of money. And that's why we're concerned about the way in which crypto investments are being pushed on social media.
What role do you think platforms should play in making sure that the financial information that's shared online is accurate and not misleading?
We've seen that platforms, the big social media platforms, have actually been a key way in which lots of scams have spread around Australia, lots of investment scams. And so with that sort of reflection, we really think the platforms need to be doing a lot more. They need to be playing a much bigger role in understanding the ads that are being placed on social media, whether they're from legitimate financial services businesses, whether they're in fact encouraging people to invest in things that are scams, and actively intervening and taking those ads down. So we'd like to see the platforms do a lot more to try and prevent harm in this space.
As you mentioned earlier, social media is already a place that young people go to for information. So it's not really practical to tell them to avoid it. So what can they do, or some steps they can take to make sure that what they're seeing is maybe legit before acting on it?
The best advice we can give is to look at a range of sources. So particularly if you're making a significant decision like investing your own money, don't do that based on one source, and particularly not if they're really pushing you to make an investment now, because that's a real red flag. You should look at a range of sources. So we already know from our research a number of young people are asking family and friends. That's a great thing to do. They're asking their existing financial institutions such as banks, they're consulting books. Do all of those things, and also look at government websites. And at ASIC, we've got an amazing independent website called Money Smart that's got information you can trust on a whole range of financial issues. And it's a great way to start your journey, is to go there for a sense of what some of the issues are and what questions you should be asking before you do further research.
Talking about Money Smart, can you talk through some of the changes that have been made to the website?
Money Smart is already perhaps the most popular source of financial information in Australia. Over 11 million people visited it in the last financial year. But we've been in the process of refreshing it, making sure all the topics that it covers are up to date, that we speak to people in language that makes sense to them, and providing tools and calculators that people can play with to get information that's relevant to their own individual circumstances. And we think that's really important, because there are lots of people out there on the internet, on social media, making recommendations, but they're pushing an agenda that suits their own hip pockets. We've got nobody's interest at heart other than those of the Australian public, so you know you can trust what you see on Money Smart.
That is ASIC Commissioner Alan Kirkland there, speaking with Stephanie Youssef. He wraps up the podcast for this Monday. Give it a rating or review on Apple Podcasts or Spotify. Click subscribe. The Reserve Bank will release its decision on interest rates tomorrow. We'll have it for you then. This SBS on the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.